Hi everyone, I'm Rick Bensignor, and welcome to this edition of the In the Know Trader Show. Well, certainly what a difference a week can make. Wow. We had been looking for the S&P to test the March lows, and we got 1/3 of 1% from there before it bounced, but what a bounce it was. Last week, the market, the S&P was up 4.4% in its best week of the year, and has completely changed the look of the market, charts, etc. So we're going to take a look at a bunch of things today. One of the sectors I want to concentrate on today are consumer staples. We haven't really looked at them in our In the Know Trader shows, and surprisingly, they're actually outperforming. In fact, here, if we take a look at the chart of the 11 sectors versus the S&P. So the S&P is on the far left in red, and then we have the other sectors going across. You can see the kind of magenta colored returns for technology, fourth from the left, and all the way over on the right, real estate are really the significant sector leaders this year, well outperforming the S&P. And the two big laggards are energy and healthcare in, I guess we'll say, teal and orange. But if you look almost in the middle of the screen, you have in kind of bright purple consumer staples. And surprisingly, even with the market up what it's up this year, staples are actually outperforming. You can see that the bar is taller. The purple bar is taller than the red bar, and that means it's outperforming. So we've got two really significant leading sectors, two really significant underperformers. And then the other 7 sectors are kind of right in and around what the S&P has returned. And some years you get a big barbell approach where you have much more outperformers and underperformers. Over the last week, these bars have shifted quite a bit because of last week's gains. And now we've got 7 of the 11 pretty much, centered around the average return for the S&P. So again, let's take a look at what the S&P is going to, what the staples are going to look like versus the S&P. And then also, I typically look at a bunch of names that are the generally the highest cap names in the sector, but I also like to go across all the subsectors within staples. So for instance, if we have time, if we get to the 10th name that we're going to look at, TAP, it's much smaller in size than if I picked second or third level down from other sectors, but I do want to kind of get a cross-section just to give you a sense of each piece of consumer staples and what they're doing. So let's shift to our charts now. As we always do, we're going to start off just looking at the S&P so we get a good sense of what's going on before we start getting into the sector information. And what we see here is, and again, I'll kind of use my friendly ellipse. So last week's low, essentially at the same level as the March low. So as I said, we got, I think it was 9 or 8 S&P points away from what the March low was, and then we ripped to the upside. So there's a couple of things here to take a look at just in general. One is, if you follow my pointer here, there's definitely a left shoulder ahead, and we at least have the left side of a right shoulder if this were to come down. So that's still, head and shoulders topping pattern is still a possibility. However, I don't think that's likely going to happen, that we come all the way down without some, again, really bad news. Trump is trying, he's clearly made things progress with Mexico. China is now on the table. So things are starting up a bit. There's still no concrete talks, but at least it's going in the right direction, and the market likes that, as well as very low interest rates. And that's, of course, all led to last week's massive rally. You can see the last 2 days, the top of the cloud is giving some resistance to the market here in and around the 2,900 in the S&P. extend this next couple of days. Similar levels, just a touch higher than where we're currently trading. So again, that is still a possibility that we get a pullback from here. But I'm thinking that there's a better likelihood that this moves higher. We'll test all-time highs, not likely stop there, and this time get through and probably get up to, let's say, 3,033. And it doesn't have to happen really quickly, but that's my guess as far as what's likely going to happen. So I'm a willing buyer on a pullback, anything from 2850 down back towards 2800. I would do some buying and looking for the market to move higher and make a more significant all-time high than we had back in very late April, which just by a few points exceeded last year's highs. So that's what I'm looking at in S&P terms. But actually, before I switch, it's still, I am conscious of the fact that we have a fair amount of a head and shoulders pattern forming. So it makes it much more difficult to go and chase after market up here. But I am willing to take the chance that we're not going to get back down to roughly 27 and a quarter on a third time. And that this will, in fact, lead towards higher highs. Okie doke. Now let's take a look at so here's a multi-year picture of XLP, which is the ETF that tracks the staples sector, divided by the spiders. All right, so this is the long-term relative performance chart of staples versus the market. And there's a couple things here to notice. First of all, before we zoom in, I wanted to give you a big broad picture and show you that in 2018, in the middle of the year, you can see over here that we bottomed into the uptrend line that started all the way back in 2006 over here. So this line has multiple hits on it. So it's significant, and when you're doing relative performance, trend lines don't have to hold exactly. You're playing more for general areas than a specific line holding. So one thing is it bottomed where it needed to and should have, and got a good rally. And of course, staples rallied in the fourth quarter while the market was coming off. And as we had the big January rally, staples came off in relative terms. All right, so that's the first point. Secondly, this is actually a pretty good trend line going back from 2011 that had also 4 touches to it, right? You need 2 to draw it, so another 2 times it held before breaking in 2017. So when and if we ever get back to this green trend line, that probably should be some type of resistance around there. And then, of course, we have the downtrend line from the 2016 high in red, which could be kind of our next target on the upside. So now let's zoom in on this a little bit so we see what some of the signals are indicating shorter term. And what I'm staring at is this 13 kind of exhaustion signal that showed up, I don't know, maybe 5 weeks ago or so. And again, that doesn't mean it has to stop. The same way this 13 over here wasn't the precise bottom, but it starts telling me we're exhausting trend. So it pushed past it, and then, of course, we got the bottom against the trend line. I'm watching this here and just saying at this point, it's harder to think that staples are materially going to outperform now. We're kind of late in its corrective phase. And if the market starts really moving to the upside, I could make the logical case that staples are not going to outperform in that move. That will likely be led by your typical more growth cyclical type areas, such as technology, industrials, maybe even financials, consumer discretionary, but not staples. So I've got a little bit of a warning sign here that we could be running out of steam. Even if we moved higher over the next couple months, as I said, I'd expect some type of resistance against the downtrend line. So I'd say all in all, it's probably an equal weight. I don't want to be overweight this. At this point, I don't want to be underweight, but I'm watching this to start seeing if this 13 gives us any reason to start thinking that we're going to get a pause here and pull back in. So that's kind of my take on staples versus the S&P. Now let's take a look at a bunch of the individual names in the area. So we'll start with Walgreens Boots. And this is a weekly chart. I think predominantly we're going to look at weekly charts just to give you the bigger picture of what's going on. And the first thing that we see here is certainly a multi-year kind of rounded top. So let's pull in some more data and just get a sense of if this top was, yeah, so it has come after a much bigger up move that started in 2012. That's the first thing, right? So now look where we've pulled back to. And again, I'll zoom this up in a second, but let's look. The lows we made this year not only were on this extended TDST line in the DeMark stuff, which is the lowest low in a 9 count, so it held against support, but look at this area here in 2013, look at the highs here in 2006, all kind of in and around the low 50s level. So we bounced against long-term support. That's a good thing for shorter term. And shorter term, I don't mean the next 2 days, but in the scheme of looking at years of a chart, this has a chance to bounce from here and get back and start potentially testing resistance. Where might we find resistance? And I would say probably somewhere around there is where all these bottoms were and where we broke down from. So that's 60-ish. So from the current 53-ish that it's trading, there's still potentially $7 or, I don't know, 14% on the upside before we start seeing resistance. What else do I see on this chart? I'm going to blow it up. Look where the peaks were made. Aggressive combo, upside exhaustion signal. 2 of them fairly close to each other. And then on the peak in late 2018, also upside exhaustion. For those of you who are potentially tuning in for the first time, this is a model that was developed by Tom DeMark. It's an institutional model that many hedge funds and institutions use to help determine when not to be a player of the current trend. In this case, these 3 signals all indicated upside exhaustion to trend. Therefore, it's at a minimum a place that you generally will not find institutions doing any significant buying. And many of them will actually do the opposite and do some selling against those levels, and clearly they have been spot on. My only concern about the recent bottom, even though it held support, is that it was not accompanied by an opposite 13 signal on the downside, essentially saying longer term exhaustion to the downside. And that's my only concern. So if I was going to do some buying in Walgreens, I'd probably put on, I don't know, maybe a small position, but not necessarily, or probably not a large one, just simply because I didn't have the 13 signal. Now, I do have a setup 9 count over here, and the setup 9 counts often are turning points. You can see it was a turning point over here, just a little early before it went down here. Now that the numbers come underneath the price bars, it gives you a sense that there's a chance, or you up the odds that you could do a turn, and that's what it's trying to do now. So, it's a name I could do some buying for. Again, 14% upside's not bad as an initial, starting point. So you're probably risking a break underneath the recent lows in order to play for a move back to 60. So risk reward wise, not a bad thing. Let's switch to Walmart. Much better looking chart, right? We just saw Walgreens, and now Walmart, obviously different pieces of consumer staples, is basically, let's bring in data again so you get long-term perspective, we are on all-time highs. And this is because of the amount of internet type shopping people now do on Walmart as a competitor to Amazon. The stock has done very well. And you can see we've just, I don't know, well, it looks like we just missed the all-time high from here. So 108, we're trading 106 and change. Yesterday, also looks like we got to 108.97. So, you know, we're essentially on all-time highs. What are the levels to look at now that we need to hurdle this teal line? This is the propulsion exhaustion signal that's been in place since, looks like April or May of last year. So it suggested we get to this level based upon the thrust. And then up at 115.5-ish are the stop outs from these two 13s. In other words, if we get above here, the 115.5 level properly, then institutions would look at these signals as being temporary pauses and new upside targets coming. And what would be the possible target? Well, this number is up to 135. So I myself am long Walmart. I've been long Walmart for years. I have a half position left. I sold half out. I got long in the low 60s, sold half out at about 77, and I have the other half, and I'm still holding this, thinking it's a good long-term play, and will likely play for a move over, you know, several years up towards the 135 level. So that's my take. Where would I start getting any bit of concern? Unless we got at this point under 90, or is that 91.60-ish or so, I'm fine on holding the need for a bigger up move. Okay, let's go to Costco, which is one of my favorite stores to actually shop in. I love the experience there. And of course, everybody likes getting good deals. So if you know the value of what you're buying, you realize how often, if you're willing to buy bulk, Costco can save you money. Couple of things here on this chart too, just of note. Back in 2017, 13 and 9 coming right close to each other. Market, or in this case, the stock sells off. 13 here did not properly exceed. Why can't I get there? There we go. Did not properly exceed this level until recently. So for, I don't know, 3/4 of a year or so, this was still indicating that Costco potentially exhausted itself. And now it's got, again, even another one. So does this mean I sell? Well, if I'm long the name, I could probably take minor profits. We're right up against the stop out level from this 13. But if this goes over time, this has a $318 target, so still substantially higher. So if you're a long-term investor, I'd stay with the name. I wouldn't be, nothing really changes long-term on the charts until I break under about, where is that, 206, 207, something like that. And this has been, for all practical purposes, straight up this year. Minor pullbacks kind of held the same level, and then we've turned around. So if we can get through this level kind of properly, where we're trading now, then this really has some room to go on the upside. So again, this is the type thing, if I'm trading or swing trading, then if I'm along the name, I take some profits here and put the stock back on if it breaks another $5 higher. That to me is worth doing when I'm trying to figure out where markets may turn, and where they may stop the trends that they're in before it's obvious that they've stopped the trend. And that's the difference between how we do things in the No Trader in our weekly report for subscribers as compared to other people. We have good models that let us identify where institutions are likely making decisions. So I'll play with institutions far more than I want to play with what the public's doing. So that's why you use these models, and they're far more complicated than a basic moving average or looking at an RSI and saying, oh, it's overbought, so let's get it out. But as I've always said, the goal of In the Know Trader is to bring to the individual investor the same models that institutions use. And since we've been doing webcasts, we've had much more interest in our product too, as more and more of you hear about it and realize the value of knowing where institutions are likely making their decisions. Okay, let's get to Constellation Brands, STZ. Again, quick look of the value of these models. Oops. Look at where the 13 show up. This one here is a downside exhaustion signal. How do I know it? Because the numbers are showing up underneath the price bars. They're counting, looking for downside exhaustion. When they come on top of the price bars, they're looking for upside exhaustion. So stock went from 175 down to 145 off of this signal, pretty much near the all-time highs. Was made on this upside exhaustion signal, and this one nailed the bottom in January this year. And notice too that we've even look at the blue nines, and they often turn. This turned upward on a blue nine. This turned downward on a blue nine. We're kind of in the middle here, which doesn't give us much to play with as far as timing. But let's look at just some basic. Here's the trend line off of the highs. Now we've got like many charts, somewhat of triangular patterns. Those that haven't made new highs, which is plenty of them, are kind of caught in between last year's highs and the, we'll say, roughly Christmas low. So right now here, there isn't much big to playing the name. Longer term, let's take a quick look. So there is some type of topping pattern here. This is a type name. If you want to be long the name, you buy on weakness. It's not one I want to chase on strength. And right now, given the recent 9 high, I kind of it would be neutral the name. Obviously bullish longer term just because of long-term structure. But this does have enough of some type of rounded top that I don't see a real edge in playing this. Let's move to Coca-Cola. So Coke, all-time highs this week. It's played, or actually we're here, so this was last week. It's played with the stop. Oops, well, let's get back to the ellipse. It's played with this 13's risk level, which is the dotted purple line. So let's see, it's still saying that this is an important area, as well as the propulsion exhaustion level at 51 and change. If it can bust through this, then over time, this says you got all the way up to 58 and change, which is close to another, 14, 15% higher. On the downside, I don't really see important support until, unfortunately, this year's lows. So they're really, when you look at this in terms of risk to reward from where you're currently playing, you have a slightly more upside up here if that's correct over time. But there isn't a real edge in playing this other than just understanding that over time, the trend is higher. This is a tight name you can see. Often gives you opportunities. It rallies and sells off. It's very choppy. So you usually get a chance to buy Coke on some type of pullback. It's not something that rips to the upside. But over time, go take a look at the last 10 years, and you can see that it's a real step up, step down type of stock. So I don't really want to chase it after here, but because the last move was down move, this type thing, I don't know, maybe if it comes off a couple bucks, you buy it. Mondelez. All right, so this was the old spinoff from Kraft. So this also shooting recently to all-time highs, breaks out of a whole sideways pattern here. So if you look at, let's make this a trend line. Right, so we kind of break out from, let's just say, that approximate sideways multi-year move. And if we count how much money that was 39 to 47, it was $8 to add 8 to 47, you get 56, and so that says the target's up here. So if the target's up here at 56, do I want to buy at 54? No, buy a pullback. We know there should be very strong support anywhere down here. So even if you get a couple bucks pullback, buy it and play for 56. Better than paying, it's hard to pay 54 when you have a measured target at 56. But great name over time. A name that just broke out to the upside this year. So it's a name I like and would definitely be a willing buyer on a pullback. Philip Morris. Totally different looking chart, closer to its lows than its highs. So barring the swoop down late fourth quarter, somewhere, let's say, in and around, let's blow this up a bit, somewhere near 75-ish is support. Because I look at this as kind of a special situation. And when you V-bottom like that, I almost take it out of the equation as being significant. However, looking at this chart, you've made no money for years in the name. Yes, it's potentially close to support, but it's got overhead resistance. It's not a name I have any interest in really playing. There's just other better names in the space to play. So I see no reason why to play this one. Here's Procter & Gamble. So this also, major consumer staple name on all-time highs, also broke out this year to the upside. It does have a 13 up year. Pulled back, it is extending. Upside targets include 112 and almost 119. I'm a better buyer if it came back under 100 in the upper 90s, 97.5, 98-ish. I prefer to buy it there on a pullback. But I like the fact that we're on all-time highs and got a breakout. Same thing, multi-year breakout this year compared to the sideways place it's been. So as we finish up now, here's how you reach me, rick@inthenotrader.com, and check out my website, inthenotrader.com. Next week, we have Corey Fleck from the Farallon Economics Group as a special guest. Tune in for that. You will enjoy it. I'm Rick Bensignor. Have a good week.
Market direction is the single most important thing all investors need to know. Get the advice you need by joining dozens of elite money managers and financial experts, including Steve Forbes, Paul Merriman, Tom McClellan, and Keith Fitzgerald at the Money Show Seattle June 15th and 16th. You'll hear real-time market analysis and learn which stocks, bonds, funds, and commodities you should buy and sell to build a safer, more profitable portfolio. Claim your free pass at seattlemoneyshow.com.